This episode of Homeowners Lab is proudly sponsored by Montana Legacy Insurance, helping families, homeowners, ranch owners, and businesses protect what matters most with trusted coverage and personal service. Also sponsored by HomeManager.io, the smarter way to organize, protect, and manage your home with tools designed for modern homeowners. From insurance insights to homeownership resources, these companies are committed to helping you build, protect, and manage your future with confidence.
Welcome to the Homeowners Lab, your source for home ownership news, real estate, mortgages, and insurance across America. Helping homeowners stay informed, protected, and prepared for what's next. Real experts, real conversations, real solutions. This is the Homeowners Lab.
Today on the Homeowners Lab, we take a deep dive into the world of FHA loans with Jesse B. Lucero and mortgage expert JC De La Torre. From first-time homebuyer opportunities and down payment requirements to credit scores, mortgage insurance, refinancing strategies, and common misconceptions surrounding FHA financing. This episode breaks down what today's buyers need to know in a changing housing market. We also explore how FHA loans are helping families navigate affordability challenges, why these programs continue to matter across Montana, Nevada, and beyond, and what buyers should be paying attention to before entering the market. If you've ever wondered who qualifies for an FHA loan, how much money do you actually need down? What are the pros and cons compared to conventional financing? How can FHA financing help first-time buyers become homeowners? What mistakes should buyers avoid during the mortgage process? Powered by the mission of the Homeowners Lab, a growing national resource helping homeowners, buyers, sellers, and families better understand the evolving world of homeownership across America.
Let's start simple. In one sentence, what is an FHA loan and who is it really for, JC?
The FHA home loan is a super great program that the government partnered up to make buying a home quick, easy, and as affordable as possible.
So JC, what is one of the biggest myths you hear about FHA loans that just drives you crazy?
That it's not a good loan. Honestly, FHA is a good option for a lot of people. It could be that it could be that you find the right house. Getting you into the house with an FHA loan could be a great option. You can always refinance out of it in the future if it makes sense. But buying with an FHA loan is a great idea and it's a great investment. You could still make money from it. You could still use it to profitably purchase a home.
So JC, when you hear FHA buyer, you get that one phone call from a real estate agent and he says, I have a FHA borrower for you. What do you picture? Is it a nervous first-time home buyer, a house hacker, or something else? What do you see?
In all honesty, it could be anything. But I believe that it's a person who is buying a home for the first time, whether it's a couple, whether it's one person. But an FHA loan is an awesome program to use if maybe your credit's not at a 700 plus FICO score. Maybe you don't have 10, 15, or 20% down to put down as a down payment. That doesn't mean that an FHA isn't a bad option. An FHA option is a solid offer. We can close quick and easy. And they're quick and easy to get you pre-approved for and closed in less than 30 days. I'm helping a couple right now. The husband is a police detective. He makes really good money, but his FICO score is a little lower than other people. He's like at a 585 FICO score. His wife doesn't work. He makes $240,000 a year. And if I just tell you that quick and easy, you're like, what do you mean? Why is he using FHA? His FICO score isn't the best. He can work on it, but he's still getting a lower interest rate than what conventional would be offering. And he's coming out of pocket with just the down payment of 3.5%.
So just a few months ago, I had somebody ask me about FHA programs. And they said, hey, Jesse, I just saw a post in one of the Facebook groups and it said, buy a home with a 500 credit score. Have you heard anything like that?
So on average, FHA would allow you to buy a home with a FICO score of 500, but you would need to put down a 10% down payment in order to complete that purchase.
So what is the minimum FICO score so that you don't have to do that?
So FHA's minimum FICO score is a 580 FICO with with you putting down 3.5% down payment. If your score is between a 500 and 579, you may qualify with a 10% down payment to purchase that home.
JC, I always thought you needed a 620 FICO score.
I think that before, certain rules that we follow, they call them guidelines. The majority of the lenders that I've worked for in the past and that I currently work for, there's no overlays, meaning that they don't add any added rules or any added FICO score limitations to qualify for a loan. So in the past, I believe that other lenders themselves, as mortgage companies themselves, would have overlays of a minimum of 620 FICO score in order to qualify for FHA. Maybe they just wanted to make sure that the loans that they were writing were going to actually perform over the years, and they weren't going to do loans for people who couldn't afford to buy a home. But that's not the case. Basically, minimum FICO score for a 3.5% down payment is a 580. If you've got a lower FICO score than that, and it goes down from like 500 to 579, you may be able to qualify with a 10% down.
So JC, let's say somebody has a 780 FICO score. Would you place them in a FHA program?
It really depends. It could be that their overall story makes it easier for them to use an FHA loan than it would be to use a conventional loan. Hey, maybe they've got an excellent FICO score, but they don't have any down payment. FHA requires a down payment of 3.5%. And your down payment could come from you. It could come from your employer. It could come from a grants program. It could come from a down payment assistance program. But it allows you to purchase a home with 3.5% down payment. And that money doesn't always have to come directly from you. It could be a program that you're using it from. And the other thing is, you mentioned, hey, someone's got a really, really high FICO score, 780 FICO. Why would they use an FHA loan? Just like I mentioned, they may not have the money for the down payment. But at the end of the day, if they've got excellent credit, they qualify for a down payment assistance, and it makes it easier for them to get into a home with no money out of pocket, that FICO score being so high would pay off for them in the long run.
I've seen students from UNLV apply for an FHA loan. And most of them aren't going to have any credit, not even probably a 400 or 500 score. So can you still work with them?
It depends. If we're using non-traditional credit scores, it could be that we can get them qualified for a manual FHA, FHA manual underwrite, but there's more restrictions. There's a lot of times you can get an approval because maybe they do have lines of credit, they have credit history, but they're not your traditional FICO-friendly reporting lines of credit.
So it can be done, is what you're saying.
It can be done. I wouldn't say it's something easy, because manual, you're actually having a physical person that's going in there and trying to find what's wrong with the loan to decline it. So I would get an underwritten approval up front before going out and shopping, especially when you're going manual. But can it be done? Yes. They're just going to ask for certain requirements in order to qualify for that.
Where does somebody have to be at?
So let's define what DTI is. A debt to income ratio. It's your debt in relationship to your income. Okay. You've got a certain amount of debt, which could be a problem. And then again, I make so much money, it's not an issue, not a big deal. So that being said, if you're trying to qualify for an FHA loan, the front end DTI must be at a 31% max, and from 31 to 43% on the front end. And on the back end, it could be anywhere from a 50 to a 57% back end ratio in order to qualify for that loan. I'm giving you numbers that you as a home buyer will not see. But basically, at the end of the day, it could be that we ask you to pay a credit card 2.0 at closing in order to qualify for the home that you want. The reason why is because that debt not being paid off will restrict you from, or will hinder you from, qualifying for the house that you're looking to purchase.
Okay, so simple math. Let's say somebody making $40,000 a year is not going to get qualified for a $700,000 house, correct?
Correct. So just to say this, for example, I'm going to ask you, how much money do you make? And I'm going to take into account a lot of calculations that basically give me the ability to realize or to understand how much you actually make on a monthly basis. Rough numbers, I can only use 50% of what you make a month.
Wow. Okay.
In order to qualify you for the home purchase.
So if somebody's self-employed, can they qualify for FHA, or is it just for W-2?
Of course, if you're 1099 and you've got a history of being 1099 for 2 years or more, we can use that income to qualify you.
JC, what if they take a lot of deductions?
There's different programs that we have that can allow us to use your 1099 and also your like money that's deposited into your account in order to qualify you for an FHA loan. But on average, regular just FHA strict loans, we are using what you actually report on your taxes in order to qualify you. So if you write off a lot of the income that you make, you can only use the income that you're showing on your taxes. But we do have other bank statement programs that are FHA and 1099 programs that are FHA programs that can help you qualify for the purchase of a home. So let's say as an example, right? Hey, I'm 1099, I'm a painter, I'm a contractor, whatever it may be, but you're 1099. It could be that with your 1099 or with the deposits into your bank account, we could still get you qualified for an FHA loan using that income that we can verify through your bank statements or through your 1099s.
What is the minimum down payment on FHA right now? And how does that compare to what people think they need?
A minimum down payment for an FHA purchase is 3.5%. But the 3.5% can come from you. Your savings, your checking account has that amount of money and you're coming in out of pocket with that down payment. Could be that you work at a company and they have a program where they help you with the down payment. Could be you have a down payment program that helps you with the 3.5% down payment. It really comes down to what would be the best option for you. But minimum FICO score, and it could be that we find you a program that covers that down payment.
Okay. And here's a huge one. Can mom and dad or a friend gift the entire down payment and closing cost, or does a buyer need to bring some of their own money?
Mom and dad can gift all of the down payment. They can gift all of the down payment and closing costs if they want to. I actually have a situation. I've got an active loan right now where the mother is the realtor and she's gifting her future commission of representing her son on a purchase. She's gifting her 3% commission towards the down payment and closing costs for the purchase of her son's house.
So, well, that's a huge benefit.
I think at the end of the day, the mom got into an agreement where he's putting in the down payment and she's paying all of the closing costs that may occur. But by my feeling, by the conversation that I've had with her, I believe that the seller is gonna cover maybe $12,000 worth of closing costs, and basically the mom's gonna have that 3% of her commission. Whether she's covering the down payment, that's totally up to her. But at the end of the day, between mom and the son, who's actually going to live in the house, they can come out of pocket with basically a minimum amount of money. So 3.5% in the way that they're using the program, it's going to be a very little money out of pocket for them.
So in your world, how often do you actually see buyers using the gift fund?
Very often. I see mom and dad helping out with down payment all the time. If a gift from mom and dad is one way, another way is, hey man, they've worked at a company, they've got a 401k, and they can use that money for the purchase of a primary residence. That's also another way of using it. I've seen employers actually just have programs where they help you with the purchase of a house. You have to meet their needs or meet their requirements, but imagine working at a place that helps you with your down payment. That would be awesome, man. I'd be happy to work for an employer like that, all right?
Oh, yeah. No, definitely. That's a huge incentive. So, JC, so sellers can help with closing costs on an FHA deal. In real life, what's the range or cap you like to work with when you're structuring an offer?
So FHA allows you to receive up to 6% of the sales price from seller contributions, which is huge. It's a huge amount of money. So I would recommend, especially in today's market, we're seeing sellers more and more inclined to help buyers with seller credits. The more seller credits you can get, the better. Any money left on the table, we're gonna find a way to use it. Either we're paying down your rate to get you a lower monthly payment and a lower interest rate. We're paying off some of the closing costs with that money.
So, JC, if someone is cash poor but has solid income, why might FHA be their best friend instead of just waiting years to save 20%?
Buy now. The house is gonna go up in value over the next few years. Why waste money saving and fighting inflation where you could just buy a house? The house is going to go up in value. You can always refinance out of a down payment assistance program you used to acquire the property. It's using other people's money to make sure that you secure your financial well-being in the future.
Let's shift from buyer to property itself. What kind of properties qualify for an FHA loan?
You can buy a single family residence. You can buy a townhome. You can buy a manufactured home. You can buy a duplex, which is 2-unit property. You can buy a threeplex, which is a 3-unit property, or a fourplex, which is a 4-unit property.
What is something that will make an FHA appraiser basically say no to a property right away?
Anything that is not safe, sound, or secure. For example, if an appraiser shows up to a property and there's broken windows, there's going to be an issue. If the appraiser shows up and let's say there's paint that's, paint chips that's scratched and stuff, it's going to be an issue. The appraiser may request you to repair that before we get a final inspection approval on the appraisal. If it doesn't have a stove, the property has to be safe, sound, and secure and ready to go. But not a property FHA, if it doesn't have a stove, we're not able to close on that deal. If it doesn't have flooring, an FHA appraiser will require to even paint over concrete floor in order to get you an approval on an FHA appraisal.
So, JC, earlier you mentioned that FHA can be used on small multifamily, duplex, triplex, fourplex. And what's different about that for a buyer who wants to house hack?
So I think the word house hack or the phrase house hack, I'm all for you using an FHA loan as an investment, right? But have this in mind. When you purchase an FHA loan, you are signing up for a loan that you plan on living in for the next 12 months as your primary residence. So is it a good investment? Yeah, FHA is a great option. Low monthly payment, low interest rate. It's a very great option to use an FHA loan, but you still have to follow the rules and have to follow the guidelines. I saw a property that was for sale that had 3 units. It was a triplex. Someone had heard the phrase house hacking. And I don't know, for me, hacking sounds like you're doing something wrong or criminal. That's kind of like what pops up in my mind, right? Let's just follow the rules. He purchased the property with 3.5% down payment. He lived in one of the units for more than a year as his primary residence, and he rented out the other 2 units. He's not doing anything crazy. House hack is making sure that you're using your money wisely and making sure that it's a good investment. He improved the property, so the other 2 units were renting at a good monthly positive cash flow. I think that's a great idea. But to think that, hey, I'm going to use a minimum down payment program and not follow the rules is not what we're here to support you to do. We want to help you buy houses, but follow the rules that FHA says.
So I have a friend out there in Nevada, Gail, and Gail has a daughter that's going to college there in Las Vegas. And one of the things that she did was she helped her daughter get approved for an FHA loan for a fourplex. And what she did is she put her daughter in one of the rooms and then she rented the rest of them. It helped her pay off the mortgage. And for Gail, she didn't have to pay any dormitory fees for her daughter.
Wow, that's awesome.
Yeah, I thought that was very ingenious how she put that together for her. So me sharing that story, JC, have you seen that happen with your clients?
Yeah, I can remember back a while back ago, I had a couple that came into my office. I took a full application for them. They told me, hey, we're not married. We plan on getting married in the future, but we're not married. And I was like, okay, cool. So what's the plan? And they said, look, there's 2 properties that are for sale, but we think both of them are a good investment. But the option that we're leaning more towards is towards a fourplex. And I was like, all right, cool. So we looked at the fourplex, and I just kind of coached them. I told them, hey, when do you guys plan on getting married? And they said, well, I have the ring already. We don't have anything set. And plus, we've got like a year and a half that we're going to be super busy with like work stuff, right? So we don't have the wedding set yet, but we do plan on getting married. So I said, why don't you guys do this? Why don't each of you guys buy a fourplex with minimum down payment of 3.5% using an FHA loan, move into one of the units, each one of you, and rent out the other 3 units. And that's what they did. They said, look, that's a great idea. We'll live in one of the properties because we're not married yet. And mom and dad would get kind of weirded out if we were living together before we were married. And then after they got married, they moved into one of the fourplexes together. So you've got on one unit, on one fourplex, all 4 of the units are paying rent. And then on the second fourplex, 3 of the units are paying rent. And they're living in one of the primary residence as their primary residence without having to really pay any rent because the other units were covering the rent or the mortgage for that.
That's pretty incredible.
But if they were married before their purchase, they both, they could only qualify for one fourplex. But before they were married, each one of them qualified for one fourplex at 3.5% down payment, which made it a lot easier. And in the long run, it really paid off for them.
So that's a really good story, JC. I now understand how people are able to use FHA to start creating wealth with that program. JC, let's set FHA next to conventional loans because when buyers hear both, they get confused. And when you look at a file, what makes you say this should be FHA instead of conventional?
Number one, their FICO score. If their FICO is somewhere around less than 700, in my opinion, could be less, but conventional is usually 680 or higher. FHA is 680 or lower, but not just the FICO, their overall situation. Hey, could be that FHA is the way to go because they've got a lower monthly payment, because they've got a lower interest rate. The other thing could be that we're in a market where people are just getting super strict and they're only taking conventional loans. It's really a matter of finding the best option for them. It could be that paying off a few credit card debts or paying down a few credit card debts and get them into a higher FICO score and get them to qualify for a conventional loan. Then again, there's the possibility of their FICO score is fine where it needs to be, and FHA still is a better option for them. The reason why is because FHA has a lower interest rate and they've got a pretty reasonable mortgage insurance, which is being charged. It could be that a lower FICO score on a conventional loan results in a higher interest rate and also higher mortgage insurance. The only makes FHA a little less attractive is that it has a funding fee. But in the market that we're currently in, where sellers are much more inclined to help with seller concessions, with seller contributions, we can easily get closing costs from the seller to cover that funding fee and any other closing costs.
Okay, JC. So if somebody walks into your office and they're looking at a $1.5 million property and they have good credit score and they have their 3% down payment, is this an FHA or will this be a conventional loan?
No, 100% will be a jumbo loan. The reason why is because FHA has a loan limit in Clark County of $541,287. A conventional loan limit here in Clark County is $832,750. You should really listen to our podcast about VA loans, veteran loans, which VAs do not have a loan limit on purchases, which is awesome. The type of loan program that in majority of, if you're buying at a 1.5 million purchase price, more than likely you're going to be using a jumbo loan.
Plain language, what's the real trade-off? Lower down payment or more flexible versus mortgage insurance and some extra rules?
Yeah, I mean, FHA is a program made for first-time home users, but it's not necessarily a program that signals or that says that this person doesn't qualify to purchase a home or is not a solid buyer. They're they're using the option because the interest rate's lower and the monthly payment results are in a lower payment because of interest rate and mortgage insurance together. Could be that a conventional loan ends up being more money out of pocket for the down payment. Could be that it ends up being a higher monthly payment because of the mortgage insurance and the interest rate as well.
So JC, so depending on the state you're in, is it different loan limits, and how can someone find out what their loan limit is based on where they live?
I would check in the county, right? So, for example, I'm licensed in California, Arizona, and Nevada. I just happen to be recently. I've been doing a lot more deals in Arizona and Nevada. So, just by coincidence, but the FHA loan limit in Pima County, which is where Tucson, Arizona is, the loan limit is $541,287. The loan limit here in Clark County is the exact amount. So kind of similar in the market, similar price point. The loan limits are the same, but I would take the time to just check what the county loan limits are wherever you're looking to purchase.
Okay. So JC, let's talk about refinance. When does it make sense to refinance out of an FHA loan into a conventional just to get rid of that mortgage insurance?
An FHA loan has mortgage insurance for the life of the loan. If you've lived in the property and you bought at a good time, let's say 3, 4, or 5 years have passed and the property value has gone up so much and so has your equity in the property as a result, you've got 20% equity in your property. That's one way of finding out whether it's a good time to refinance. The other one is whether rates have dropped, and as a rate reduction on your mortgage, it would make sense and it would save you money on your monthly mortgage payment. Those are the two main factors that we look at to determine whether it's a good time for you to refinance.
So is this something you should be looking into as a homeowner yearly, or how often?
I think that every 6 months I have a mortgage review with people just to make sure that we're going over the important factors of a mortgage, because you're paying that mortgage every month. And that's one of the conversations that we have to ensure that they're in the right mortgage program. But could be that a refinance, not only just to lower your monthly payment, could be a refinance to maybe get some debt consolidated into your mortgage, paying off some credit card debt, maybe some personal loans would be a good option as well, because your equity is increasing. But if that only results in I owe less money on my mortgage, but I've got credit card debt that's out of control, could be that us using your mortgage equity into a refinance to get rid of some of that credit card debt that you have would be a good option.
If you had to give a first-time home buyer a 3-step plan to be an FHA-ready applicant in the next 6 to 12 months, what would those steps look like?
Number one, make sure you stay at your job and that you're getting paid well at your job. If it's time to ask for a promotion and get paid more because rent is tight and money isn't enough, let's get a resume ready. Let's start making as much money as we can. Number one. Right? Number two, credit is a big deal. So the less debt that you have and the more active, positive credit lines that you have available to you, the better. The higher your FICO score, the more options that we have to get you into a good deal on a good loan program for you. Whether it's FHA or conventional, same rules, same good jobs and good credits are always handy. And the third part, save up some money. You're making more money at that new job that you found. You're making more money at your current job and got a raise. Save some of that money up, because it could be that we need some money for your down payment. We need some money for closing costs. We need some money for a house that you really like, but it needs some tender love and care. You've got that money to make it happen. You've got that money to complete the purchase, or you've got that money to fix up the house the way you want.
What's the biggest mistake first time home buyers make before they ever talk to a lender?
They assume that they qualify. There could be some things on your credit that keep you from qualifying. Us addressing any credit issues up front is going to make it a lot easier for you to qualify and to get into a home a lot easier with a much better program, much better interest rate.
And would you rather have someone call you 12 months before they want to buy, or 30 days before? And tell me what.
12 months before. If I've had people call me 24 hours before they're looking to purchase a home, And it's tough to piece the deal together when all of a sudden it's the house of their dream and really like, hey, it's a house that's down the street from my mom and dad. My mom and dad are my babysitters. It would be so easy if I bought that house. A little preparation goes a long way. Have we made it happen within 12 or even 24 hours? Yeah, of course. But just a little heads up to help us prepare you for a purchase is a lot easier and makes the process a lot easier.
So, what's the one green flag that tells you this buyer is going to close and not just window shop for the next year?
Their attitude, you could hear it in their voice. They know that that's the house that they're into, that they've got their credit on point, that they've got their income on point. They're working, they're making money, they're paying their bills, and they're ready for a house. You could hear it in their voice. It's funny, but you hear the difference whether someone's just going to kick some tires for a year or two, or someone's gonna go and find a house this weekend.
Gonna land this with a quick rapid fire round. Short answers, good answers.
Okay.
FHA in one word.
Home affordability.
Minimum down payment.
3.5% down payment, or let's use down payment assistance where down payment assistance is helping you with that.
Ideal credit score for a smooth FHA approval.
I would say 680.
Favorite type of FHA client to work with.
First time home buyer.
Biggest FHA myth in one sentence.
That it's not a good program, that it's only for people who don't qualify for a quality loan.
One thing you wish high schools taught about home loans.
Paying your bills, having a good job, the good old-fashioned hard work pays off are the rules that should be taught and never stop teaching our students. Because if you pay your bills on time, if you've got a good job, if you take care of your credit and you save some money for some down payment, you can make a great investment and buy a house every year, another property each and every year. Shouldn't be that hard for you to do.
Your hot take is renting always throwing money away? Yes or no? And why?
It depends. If someone is going to rent a house because of COVID and some of the changes that have happened where they require more money as a security deposit, it could be that buying a house is a better option. The reason why is because they're literally asking you for a down payment, not a security deposit. So you buying a house, living in it for 1 year, and then you plan on moving somewhere else in a year. Could be that you basically put down some roots for you to live in that house, or you put down some roots to set yourself up for a good investment property.
When rates eventually drop, who will be the biggest winner among today's FHA borrowers?
The people who already own a house. When rates drop, it makes the purchase market a lot more competitive, meaning that home prices go up, meaning that sellers don't have to help you with closing costs anymore. But if you own a house already and rates drop 1 point or 2 points, you already have the house. It's just a matter of you calling me and telling me, hey, remember you helped me 2 years ago with my purchase? Yep. Well, I saw that rates drop. Maybe we can take a look at refinancing the house. And when we refinance, you're not in a hurry. You already live in the house. You're not in a hurry. You already own the house. It's just a matter of us ordering an appraisal if needed and closing on the refinance that'll save you some solid money each month on your mortgage.
So JC, this has been super helpful. I know a lot of people listening are realizing, okay, maybe I'm closer to buying than I thought. For the listener who's thinking I might actually be an FHA buyer, what should they do in the next 24 hours?
I'm here to help. I'm here to make it easy for you. Believe me, if you think there's a piece that's missing, I may know a solution that's quicker, easier, and cheaper for us to get you approved to purchase a home as soon as possible.
If someone wants to connect with you directly, what is the best place for them to find you online?
If you want to do some reading and find some good information, go to the homeownerlab.com. Once you start reading all the information that's on there and you're ready to talk, give me a call. My name's JC De La Torre. My phone number is 520-249-2245. Together with the information that we've been sharing online at homeownerslab.com and the conversation that you and I will have, we'll make it as easy as possible for you to purchase a home.
Carlos, I appreciate you coming on and breaking this down in plain language.
Thank you so much for having me. That's what we're here for. We're here to help people buy homes in a quick and easy way. Got any other further questions? You know where to find me.
And for everyone listening, if this episode helped you, share it with a friend who's thinking they may need 20% down to buy a home.
This episode of Homeowners Lab is proudly sponsored by Loan Depot and Juan Carlos JC De La Torre, trusted loan consultant serving Las Vegas and beyond. Whether you're buying your first home, refinancing, exploring renovation financing, or planning your next investment, JC brings knowledge, experience, and personal guidance every step of the way. Connect with JC De La Torre today at 725-229-7117 or email jtorre@loandepot.com to learn more about your home loan options. NMLS number 1098316.